Hello, I'm Greg Bell, and welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights to help boost your trading potential. Coming up, investors digesting the latest Fed rate cut, but with stocks trading near record highs, how should they navigate these lofty valuations? Just a few minutes' time, we're going to speak with renowned economist and strategist David Rosenberg to explore what investors should be watching and what it could mean for their portfolios going forward. Plus, we're going to take a deeper look at what's fueling the market gains, assess the breadth of this rally. That's all ahead. You're watching TD Active Trader Live. Check in on the markets. We got some green on the screen, really being led by tech for the S&P 500. Obviously, there's a lot of drama yesterday afternoon. You can see the markets come off on some comments that Chairman Powell made before they moved higher, and then today popped higher at the open. Fed announcements always have a lot of gyrations. Let's check out the heat map and see if it's still the tech story that is propping up this market right now. And indeed, you got Nvidia, Google, Meta, Broadcom, AVGO, all to the upside, putting some points on the table. But the financials are no slouch either, or the industrials. So we got a bit of breath here. Heron's going to be speaking to that a little bit later in the show. Now, Intel doesn't take up a lot of size on the screen, but what a pop for the stock. 25, 30% the last time I put my eyes on it. What is going on with Intel to get a move like that? Well, Nvidia is going to invest $5 billion in the chip maker. They'll co-develop chips for data centers and the PC market. Nvidia is investing its stake at a price of $23.28. Now the shares have moved far beyond that. Perhaps some excitement that Nvidia is getting behind what has been a troubled company. The CEOs of both companies apparently going to hold a press conference 1 p.m. Eastern time today. Want to get you caught up on Darden restaurants because we did mention it on Tuesday's program. Jason Natick did a look ahead to the earnings, and they were mixed. The stock is under some pressure today. Olive Garden and the Longhorse Steakhouse, well, they helped offset some weakness in the fine dining business for the name. So they're raising their full-year forecast. So that's good on the top line, right? But when it comes to the bottom line, they're really not changing that. So some caution in the markets right now. And that's your market update. Joining me now from London, Ontario is my colleague Hiran Amin from our direct investing educational team, and veteran economist and strategist David Rosenberg, founder and president of Rosenberg Research. He's joining us from Toronto. Gentlemen, thanks so much for being with us today. We got a lot to get to.
Absolutely. Great to be back here, Greg.
All right, so everyone's obviously got their eyes on the Fed yesterday afternoon, what happened there. David, I want to pick your brain about this because, you get the rate cut you're expecting from the Fed. You get the dot plots coming in line as to what, roughly the market's expectations. Then Jerome Powell throws out a phrase like, this is a risk management move. What do we take from that as investors? What did you take from that, David?
Well, I think that the markets overreacted to that new phraseology about risk management because the Fed has always been a risk manager in both directions. So I think that the bond market probably wanted to hear something more forceful that this was beyond just risk management, that we are so concerned about the economy that we're going to drive rates even lower. And that could be it. I think a lot of the move, look, after the press release, we got to 3.99%, and grabbing a 3 handle in the 10-year note probably forced a lot of the long players who made some serious money in the bond market to take their profits. So a lot of this is just market positioning. I wouldn't read much more into it than that. We've got to deal with what we know for the here and now, which is that the Fed is back on a rate cutting program. They seem to be at least committed to 2 more cuts at the last 2 meetings of the year. And although the dot plots show that there's still going to be a path towards lower rates, not significantly lower from where we'll be at the end of the year, we'll see what happens in 2026. The Fed is not just a risk manager, but they're also data dependent. So it'll be the data that guides them. I still think what's more important is the destination than necessarily the path towards a destination. Trying to time these things is always difficult. But I think that the key for investors is that the Fed, after a long pause, is back on track cutting rates, and that the trend towards yields out the curve, notwithstanding the backup in the 10-year, in the past 24 hours, I think that downward trend and steeper yield curve in a bull steepening environment is going to remain intact.
Right, David, so that destination, I want to talk to you about that. Where do you perhaps think we do land in this rate cutting cycle? And what's it going to mean for the US dollar? The currency has been weak against a basket of international currencies for some time now. Could that continue now that we're on this rate cutting cycle?
Yeah, I think that the Fed's telling us that neutral, as far as their estimate's concerned, is 3% on the funds rate. We're still more than 100 basis points above that. But I actually believe that the labor market is going to weaken sufficiently to tip the economy into recession, the recession that everybody missed, including myself, in 2022 and 2023, because we underestimated the power of the lingering effect of the $2 trillion of cash stimulus from COVID that was still in the system. That's why we didn't get the recession. So I think that my estimate for the Fed funds rate at the low, it could be 2027 or it could be next year, but in terms of destination, I think we'll get down to 2% on the funds rate in nominal terms, and it'll be 0 in real terms, which, by the way, is where you normally get to at the trough of a Fed easing cycle.
David, I'm going to jump in here. Thanks for being on the show with us. I just wanted to talk about the equity side of the assets here. Now, we know with the equity risk premium, it's at historical lows, which means that any assumed future returns on stocks are unattractive relative to the risk-free bond yields. And I know in your note to clients, you mentioned sticking with the bond bullion barbell strategy. So can you talk us through that a little bit?
Right. Well, look, I think that when the Fed is in an easing cycle, rates come down across the curve. I know there's a lot of people that are saying that inflation is sticky. There's some people that are saying that as the Fed cuts the short end, then long-term rates will go up. That doesn't happen. Even in the 1970s, 3 recessions that decade, and in the recessions when the Fed was cutting, you wanted to own bonds, even though inflation was sticky and we were in a stagflationary environment. So the reason why you want to own bonds is because of the convexity. And as rates come down, you're going to get a very nice price appreciation on your bond. And the total return, I think, will be somewhere around 10% on the 10-year Treasury note. And as the Fed cuts rates, and I think there was a comment before about this, yes, the rest of the world will largely be on hold. The ECB and the Bank of England have already done quite a bit of work, especially the ECB. So as interest rates in the United States come down and converge on the rest of the world, it's going to drag the US dollar down. It's already down 10% so far this year. And I think we're on the cusp of seeing another 10 to 15% decline in the US dollar. Well, what is the best hedge against a declining US dollar? Well, the best hedge out there is gold.
It's gold.
So gold's going up for other reasons, because it's hit new highs in every currency term. Gold is breaking out yen, sterling, euro, Canadian dollar, New Zealand dollar. That's when you know that gold is trading more as a currency that is no country's liability, as opposed to trading as a commodity. You got to treat gold as money, but money that doesn't pay any interest, which means when interest rates go down, the value of gold goes up. There's other reasons to like gold, but that's one of the principal reasons. Lower rates and a lower dollar is just fuel for the gold trade. So I call it the bond bullion barbell, and actually, year to date, that blended return is plus 25%. So it's done even better than the beloved S&P 500, Dow, NASDAQ 100. So what I'm busy doing is trying to devise ways to generate equity-like returns without taking on equity-like risk, especially with these insane multiples we have on our hands right now.
Yeah. So actually, let's talk about the multiples for a second, since you brought that up. And I love the point you talked about gold being as a currency, thinking of it differerly. We know the Cape-Shiller ratio, which measures the valuation, it's at levels that are rivaling 2021, 2000, 1929, and every time when it's proceeded that, we've seen painful bear markets in the years following those peaks. So with the stretch valuations already in our markets domestically in the US, and you've also got another statistic, which is margin debt levels almost topping $1 trillion now across the board. So real complacency in the market. Where do you see your outlook for equities, both domestically here, but also globally as well? Are there opportunities even just beyond our markets here? And is it going to be the same effect across the board?
Yeah, well, the S&P 500 stands out by far as the most overpriced and expensive market on the planet. So for some time, we had been advocating U.S. investors in particular to look at Canada, where up until about 9-12 months ago, the valuation discount was huge, but also Europe, but principally Asia. Asia has been our favorite geographic destination for equity market performance, and it's actually done better than the S&P 500 has, although we just focus on the SPX at the expense of everything else. I think that your point's well taken. 38 multiple on the Cape, and that is extreme. In fact, when you're taking a look at valuations and sentiment and market positioning, you're talking about more than a 2 standard deviation event. And when you get to more than a 2 sigma event, that is what a bubble is. And we are in a bubble environment. And as Bob Farrell famously posited, bubbles can last longer than you think, and it's lasting a long time, but they don't ever correct by going sideways. And the old adage that the higher they go, the harder they fall. And I'm not going to say that valuations are a timing tool. They're not. But valuations, and you're right, the Cape is my favorite because it goes back like well over 100 years and it smooths out the cycle. It's a great valuation metric, not from a timing perspective, because investing is never black and white. Investing is always various shades of gray, and you're always playing the probabilities. So do you want to invest with a tailwind at your back or a headwind in your face? And that's what we have on our hands right now. As I said, not a timing tool, but when you're at a 38 multiple, 38 on the Cape, your future expected returns are negative. And in fact, we went back in the history books and found that the key threshold is 35. Once you break 35 on the Cape, and you look at the 1 year, 3 year, 5 year, and 10-year returns in the S&P 500, they're all negative. It's the only part of the tranches you look at in the Cape where everything winds up negative. So frankly, I like to invest when expected returns are significantly positive. And they're not right now if you're willing to take that 1 to 5 year view. It's not a 1 to 5 month view. This thing could still go even crazier.
Yeah.
But it's a massive constraint right now on potential future returns. And there's other markets around the world, like I said before. Or you can just invest in sectors, aerospace defense globally. That has visibility. I found that a cheaper way to play the AI trade has been through utilities. I love the Canadian pipelines. Most of all, gold, silver, and the mining stocks have been a great place to be. And I think that will continue. I think we are in a sustained bona fide secular bull market in gold, silver, and the miners. So in this sort of insane environment, which is really more about Mag 7 and the fact we have $9 trillion stocks in the S&P 500 is so incredibly concentrated, I'm shying away from buying indices and focus more on better value across the Pacific, in Asia, and focusing more on sectors as opposed to headline indices.
David, when you talk about strength in mining, it makes me think about the Canadian market, even though you said you're not playing broad indices. We had a rate cut as well. I mean, it gets overshadowed by the Fed always because that's the bigger news globally. But there seems to be a feeling in this country that this economy needs some help. We've seen the numbers. They're not great on GDP. They're not great on the labor market. From your point of view, what does this economy need? It can't just all be monetary. Surely they need a bit of a fiscal push as well.
Right, I tend to agree with you. And to say that it's not great, I mean, that you're being charitable. I mean, the economy is absolutely flatlining at best. Employment's going down, the unemployment rate's going up. I was surprised that the Bank of Canada stayed on the sidelines as long as it did. because again, I don't look at tariffs as being inflationary, and I look at it as really as a tax on purchasing power. I find that funny that people talk about tariffs and inflation. Go back to the 1930s with Smoot-Hawley and tell me how much inflation we got from those tariffs. They actually end up being more deflationary. But the Canadian, I think the Bank of Canada has got at least 2 more cuts. I say at least. I think they're going to have to take the policy rate below 2%. The economy is very weak. And what's more important is that the disinflationary output gap, the amount of idle resources in the economy, especially the labor market, is expanding. That puts downward pressure on nominal wages, and that's why there is no inflation in Canada outside of, if you're taking a look at the fact that the CPI includes mortgage interest, which is ridiculous. Can you believe that the StatsCan has mortgage interest costs in the CPI? Did you know that? When you go to Loblaws, do you say, "Hey, honey, beside the Cheerios is mortgage interest. Can you pull it down for me?" But when you exclude mortgage interest, inflation in Canada is a non-event. It's running like barely at 1.5%. So the bank's got to cut rates. And you're right. Is it the only game in town? Well, right now it's the only game in town. I guess that Mark Carney's doing his best to fast track these natural resource projects. But they're long gestation periods. Like, you're not going to say, "Oh, I'm going to remedy the negative vagaries of the business cycle through fast tracking natural resources." That's something that is going to help us, hopefully, with our long-term growth potential. We're talking about the here and now. And I'll tell you, you're 100% right. The biggest crime that was committed, and it's a crime that continues to go unpunished, is that Donald Trump, after he got elected in 2016, with the help of Congress, cut the top marginal corporate income tax rate in the United States from 35% to 21%. 21%. And we just sat here idly by without any response. We are the smaller neighbor. We are the junior cousin. And we have to have competitive tax rates in this country.
We used to be competitive on that front, didn't we? I can remember companies redomiciling here.
Until December 2017, we were competitive. So now with the provincial abatements, the top corporate rate in Canada is like 26%. In the United States is 21%. But you see, in the United States is actually a capitalist country. I don't know what we call Canada. Nobody in the United States had a problem with corporate tax rates going down. Nobody accused the government of being, gifts to the fat cats. They cut corporate tax rates. 2/3 of the employment in the economy come from corporations. But in Canada, the business sector is viewed as something evil. You can't cut business taxes. Where did that come up? So, the thing is that the biggest disappointment isn't necessarily on trade and tariffs. And I think that Mark Carney did the right thing by getting rid of those, countervailing responses that we had. That was definitely not helping out the Bank of Canada's case and only creating more problems for the Canadian private sector. But really, like, the answer to Canada's fiscal challenges was to reduce the low end of the personal tax rate strata by a full percentage point. Like, are you kidding me? I was hoping that we were going to see, and maybe it's more a prayer than a hope, because Canada's fiscal balance sheet is much stronger than the US's. I know we always bellyache about, we're going to get the budget coming out in November, and everybody's belly aching about the deficits and debts. Our balance sheet is probably about as good as Germany's. And look what Germany's doing now in fiscal policy, and especially in defense and infrastructure. But the thing is that we are not tax competitive. And this is why Canada's economy has been lagging for so long. When you look at the balance of payments data, this is shocking. That in each of the past 10 years, Canada has suffered net direct investment outflows. This isn't paper, this is bricks and mortar investment. 10 years of negative direct investment outflow. And you know what? That is costing the economy a full % of GDP growth each and every year. And you know what? The only person talking about it has been me. But I sort of sometimes get tired of reading my own research. I wouldn't mind reading this from somebody else. But that is one of the dead weight drags on the Canadian economy, is our decision deliberately in the name of social policy, I suppose, to maintain an uncompetitive tax structure. Now, we always complain about where personal taxes are vis-a-vis the U.S., and I agree with that too. However, we do have public funded health care here. But, people can't just pick up and move to the States, especially now. But capital is freely mobile. Capital can move. And capital creates jobs. But the problem is that does not. Look, we just elected a left-leaning liberal government after 10 years of incompetence. We Canadians voted them back in. So it comes to the nature of the fact that you can never campaign on lower corporate tax rates in this country. You'll be impaled because it's a tax cut to fat cats, the business sector. Never mind that the business sector employs 2/3 of the people in this country. But that's really what's needed. We need massive pro-growth tax reform.
Sounds like we need to have you on after the federal budget in November as well, David. We'll be able to go through and we'll see if we'll get any of those things in the budget. It's always fascinating to get your insights.
Don't hold your breath. Don't hold your breath on that.
We'll see if I can hold this in November. David, always fascinating to have you. It's been a long time since we had a discussion. I always enjoy it so much. Hope we get to do it again sometime.
Great. Thanks for having me on.
Yeah, that was a pleasure.
That was David Rosenberg, founder and president with Rosenberg Research. To learn more about David's team, their insights, and how to access their research, go to rosenbergresearch.com. And just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. And of course, the views and forecasts expressed those by David are solely of David's and his team at Rosenberg Research, which is based on their research. Now, herein, David gave us a lot to think about right there. He's always fascinating to listen to. A lot of things really jumped out. I was taking my notes. I don't even know where to begin. Let's start with gold. Right? You talked about the gold, the bond bullion barbell, and you talked about gold is trading as a currency. The U.S. dollar, the world reserve currency, will continue to weaken. There's a lot here. What's really stood out for you?
Yeah, the other thing was the equity space we talked about, right, Greg? We talked about the valuations, and he's really, he's not seeing that the risk premium is justifiable, but he also mentioned that he's getting similar risk returns on the bonds, which is kind of makes that second part of it, right, Greg? The bond bullion barbell strategy. So over, possibly like weighting allocation more in the bond side, especially on the longer end of it. If you look at the curve and the convexity, with meaningfully, we know the relationship. As rate cycles come down, you'll see bond prices starting to tick up as well. So maybe that's a forecast going into it. So that was one thing that I kind of picked up on. And then he talked about like not even getting so much exposure to specific indexes, but more on looking at sectorial opportunities in defense, maybe utilities, which is kind of what I think of as like the fuel to light the fire of AI, essentially. So some players there with silver, gold, of course, and some other minerals like uranium as well that might be things to look at.
A lot of great stuff in that conversation. I think our viewers would be well served by going back and watching it again at the end of the show. Wait till we're done the show, though. If you at home have a question for our guest or our team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, where you can try out the TD Active Trader platform risk-free. You just open a practice account by clicking on that Try TD Active Trader button. And then when you're ready to switch to a live account, you simply export your workspace, start trading for real. Now, for more technical take on what's happening in the markets, we're back in rally mode today. I was so enthralled with what Dave was saying. I haven't been checking my screen, but no, we got the S&P 500 up 0.75%, the Nasdaq up more than a full percent. So we often say the criticism of this market is often that it's the Mag 7, it's the tech stocks lifting all boats. How broad is this rally?
Yeah, it's in fact, it isn't very broad, as you mentioned. And when we'll talk about breadth in just a moment. I don't have a chart on it just yet, Greg. But when it comes to valuation, a lot of this valuation is driven by really a specific sector, and that's the AI plays, the Mag 7s that are really, pulling the markets up. What I wanted to focus on was with the S&P 500, and especially looking at valuations. Now it's at a point where, David mentioned this as well. It surpassed the dot-com bubble and even the run-up to the Great Depression. This is where we are right now. You've got margin debt that currently sits at 1.02 trillion as well, which is an all-time high. And then, the downside risk to this whole market is stagflation, and eventually, if that plays out on a longer term, it's recession, if that's going to come into play. So let's look into the charts and see what's going on right now with the S&P 500. We saw that bit of a knee-jerk reaction. I'm going to start with the tops over here. You saw this sort of big sort of candle. It's a doji candle is what we recognize it, where you have a long shadow. And this was just on the announcement when Powell came to do the speech at 2 o'clock. We saw a knee-jerk reaction. Markets kind of digested that risk management tone, what he messaged, and then we kind of closed a little bit at parity, just a bit slightly down. But today we're back up. But the way the shape is happening with the S&P right now is we've got these this rising wedge, or this rising channel, if you'd like to call it. And it's basically two of these trend lines connecting the highs and the lows together. But you'll notice that it's starting to converge over here. And we are looking for a breakout, either to, now most typically this pattern is a bearish pattern, what it signals to us, a breakdown to the downside. And what we want to see if that does happen, it's respected for the most part. We did see a slight breakdown coming down here, but it's the confirmation that's important for us, Greg. And confirmation is really, we want to see at least a second and third day closing below this what is now acting like a support, dynamic support line. And we want to see even making a newer low. So if you see the close happen on the confirmation is we want to see a lower close than the previous candle's close over here. So that's the one to keep an eye out. When it comes to momentum, though, we're seeing it kind of hit that overbought territory with the RSI. It's still firmly with the MACD convergence, still showing momentum strong there. We don't have a signal yet that we could see a breakdown, because we want to see the RSI go into the overbought and then come and cross back below it to see if there's a momentum or breakdown or divergence, as we like to call it, from currently what's happening in the market space. And you talked about breadth. It is narrow, Greg, and that means there's only a few people. There's a few participants that are really dragging, that really are pulling this. And historically, when you have such narrow breadth, it does precede. It precedes a period of volatility. So catch-up moves by lagging stocks, and it may suggest choppiness in the short term that we're headed for over here.
All right, so great look there at the broader markets and the concentration of what's fueling these markets right now. I think you have Netflix on the mind as well.
Yeah, I wanted to just throw an ode to Netflix. It's kind of been that sleeping giant. We haven't had a lot of action on it. They will be coming out with earnings in just over a couple of weeks, a few weeks time, I should say. Recently, we just had the the award ceremony for the TV shows just wrap up, and they were tied for with the most wins with the network with HBO Max. Now, coming into this, one of the things I wanted to look at was Netflix, we know, has abandoned its key metric, and that's the subscriber numbers. They're not giving those subscriber numbers right now, but they have quite a bit of a big pipeline, and they've done quite some spending right now. They do 17 to 18 billion on entertainment content. That's more than any company out of the most developed and one of the most developed networks on a global scale there. So when it comes to the charts, though, what we've seen is we have seen it make the rise. This is the full one. This is the one-day chart that I have on a yearly basis we're looking at over here. And we did see a breakout of this key double bottom, which had started this upward trend. But then we've now hit this period of sort of lagging and choppiness where it's just gone range bound. It kind of made this highs. This represented all-time highs, just breaking above, just shy of that 1350 level over here when it came down back. It is kind of been hugging with that 21 and 50-day moving average. And you can see just the way those slope right now. They're just going sideways. They're not really picking a direction. So there is a catalyst that we're waiting on to see if we can have it. Maybe that is the earnings that's going to come out over here. We do see this range is about $270 range. So coming into that earnings play, potentially we could see a break. Right now, the big break that it has to have is the 1275 resistance level, which is rejected a couple of times early on in July and just most recently over here, to see if we can have another leg up towards this new sort of resistance level, or the leg down where it's still finding support at the 1165 level there right now.
All right, so we got our price action on the screen, we got our resistance, we got our support. Now you're going to walk us through a couple of ways we could trade Netflix. But before you get started, just want to remind our viewers that options trading carries high risk, may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Take it away here and walk us through it.
Yeah, let's start with the options trade. We're going to do with the bull trade to kick us off here, Greg. I'm going to just switch my charts and look at the potential trade that we can do over here. Just stretch this out a little bit. So one of the ways, if you were bullish going into this earnings and if you expected that volatility can pick up a little bit, one of the trades you could do was a bullish long call condor strategy. Now, essentially, this is it's comprised of 4 legs, this strategy. We're essentially creating a debit call spread and then a credit call spread as part of the strategy. So the idea here is risk mitigation, which is foremost whenever you want to trade options, Greg. And the reason I want to do this is because when you think of a stock like Netflix, which is trading in the 4-digit range, it's currently sitting at about $12.25 right now. It's expensive. The options are pretty pricey if you're looking to go get single exposure with a single leg call. So by doing a spread, in other words, we're selling the other side of it, we're kind of reducing that cost. But I want to even further reduce my downside risk, and that is by selling another credit call spread to take in some more premium. So this trade, we're looking at just the 24 October cycle, which is just coinciding with when the earnings is currently slated for on the 21st of October there. So the 1220 strike, which is pretty much at the money, selling the 1270, giving us a 50-point wide range over here, and then further out giving us a little bit of a break, so we have that FOMO, and then we got 1300 by 1350 is what we're selling the credit spread for. Currently this trade on the market is the premiums trading for about $15 or so. So in other words, our break-even price is looking to get to $12.35 on the upside until we start making profit above that. And $12.70 would be representing our max profit. So it's just the difference. You take the $50 minus what we're looking to spend on this, which is $15 or $1,500. And that difference equates to about $35 on this trade if it goes our way, which is equivalent to $3,500 on a single contract there.
I'm going to ask you, what if it doesn't go your way?
I was waiting for it. Yeah, what if it doesn't go your way? So there's 2 scenarios that can play out with this trade. One is the downside scenario, which we talked about, and the trade, and it in fact doesn't hit this level and falls below our long strike, which is 1220. In that case, and if we're holding it close to expiry, we're going to lose the premium that we paid for this, which is the debit, which is that $15 or $1,500. Now, you can also lose the premium if we have an outsized move where it does really end up taking out its previous high and actually capturing and getting back to 1350. It's almost like a scratch trade in that point because you made the $50 on the spread here, you lose the $50 on the credit over here, but at the end of the day, it's a scratch. It's just what you end up paying. So it's still the $15 is what you're losing to stand to lose on either side of this if it really pushes up higher or it doesn't, it breaks below the 1220 mark there.
All right, that's one possible way to play it as a bull. How could you possibly play it as a bear?
Yeah, let's look at bear trade. So in the bearish one, we'll look at the setup. This is going to be more vanilla. So in the bearish spread, we did identify those levels where we think if it breaks below, there is a target right around this 1165 range over here. And so this is going to be another spread strategy. In this case, it's going to be a debit put spread. So we're looking for directionality over here. This is not a trade we're trying to hit for the fences or look for a big home run here. Again, it's all about risk mitigation. So we're selling another put with the put that we're buying. So we're looking to buy the 1200, which is just slightly away from where the current price is right now at 1225. And keep it still 50 points wide. Again, it's up to the risk tolerance of whatever your appetite is in terms of how wide you want to go with the spread. So we're keeping it 50 points, and this trade is really costing us about $17 right now with what the market is indicating. And so again, we want downside movement, so the way we would figure it out is you take your premium, which is the $17, subtract it from the 1200 price, so that puts us as 1183 is our break-even price. So anything below 1183 is when we start making some money on this trade there, Greg.
All right, and on the other side, what's the risk?
Risk is it goes the other way. Because this is a very directional trade, we are really expecting it in the time frame that we're looking at. We need that trade to go in our favor. So if it does go and course corrects and heads up back towards its resistance level and it's away from the 1200, we're going to lose that premium that we paid. In this case, it's going to be the $17 and change that we're looking to get in for.
All right, fascinating stuff here. And I think this was a pretty good inaugural Thursday show. David Rosenberg, so much to think about. Some really interesting work there. We're off to a good start. We'll be back on Tuesday, of course, with the Bear Bull debate. And then every Thursday going forward, we're going to have this installment as well. I'm excited. You excited?
I'm definitely excited, Greg. This is a fantastic debut that we had. Looking for more insights from David, of course, but we've got a whole host of fantastic, guests lined up over the next coming weeks. So stay tuned, folks, for everyone, and join us back on Tuesday, but back on Thursday as well.
It's going to be good. 2 days a week for TD Active Trader Live going forward. That's the show for this week. As always, investors should perform their own due diligence before engaging in trading. Thanks for watching.